The Dhandho Investor by Mohnish Pabrai. Picture this. You've just lost everything. Your home, your business, every possession you've ever owned, all ripped away in an instant. You land in America as a refugee in the early 1970s, with empty pockets, minimal education, and English that's shaky at best. Success? That's not even on the menu. You're just trying to survive. Now here's where it gets wild. Fast forward 35 years, and your tiny, struggling community doesn't just make it. They absolutely dominate. We're talking ownership of more than half of all the motels across the entire United States. Over $40 billion in assets. Nearly 1 million people on the payroll. $725 million in annual taxes. How on earth does that happen? How does a group, starting from absolute zero, achieve something so extraordinary? Here's the kicker. It wasn't some high-wire act of venture capital gambling or the next hot tech innovation. It was something far simpler, far older, and honestly, far more powerful. A mindset that completely flips our understanding of risk and reward. This is the beating heart of Mohnish Pabrai's modern masterpiece, The Dhandho Investor. Pabrai, himself a brilliant investor, peels back the layers on this counterintuitive path to wealth. He introduces us to a Gujrati word, Dhandho, which translates literally to endeavors that create wealth. But it's so much deeper than that. It's an entire philosophy of business and investing, built around one elegant, almost cheeky concept. Heads, I win. Tails, I don't lose much. Today we're diving headfirst into this philosophy. We'll meet the unstoppable Patel motel owners, the larger-than-life Richard Branson, and the quietly brilliant steel magnate Lakshmi Mittal. They all use the exact same playbook to build their fortunes. By the time we're done, you won't just have a new investing strategy. You'll have a completely different lens for seeing business, opportunity, and wealth itself. You'll understand how to stack the odds so overwhelmingly in your favor that losing becomes almost impossible. The Dhandho story starts with a group called the Patels from a small region in Gujarat, India. In 1972, Uganda's dictator Idi Amin kicked them out, seizing everything they owned. Thousands of Patel families became stateless refugees, eventually landing in England, Canada, and the United States. They arrived with basically nothing. But they had something far more valuable than cash, an instinctive grasp of Dhandho. So what did these first Patels do in America? They didn't try to reinvent the wheel or launch some risky startup. They looked around and spotted something simple, a dying business. America in the early 70s was a mess. An Arab oil embargo had gas prices through the roof, and nobody was traveling. Small family-owned motels along the highways were collapsing like dominoes. Banks were foreclosing left and right, selling properties for basically nothing. This was a distressed industry, unloved, hated, drowning in uncertainty. And that's exactly where the Patels saw gold. Let's imagine a guy Pabrai calls Papa Patel. He arrives with his family and a few $1,000s he managed to smuggle out of Uganda. He spots a 20-room motel for sale at a laughably cheap price. He realizes something brilliant. If he buys it, his family can live in a couple of the rooms. No more rent, their biggest expense, gone. He scrapes together about $5,000 in cash from savings and family loans. The desperate seller and a local bank, both eager to unload this albatross, agree to finance the rest. Now watch the Dhandho magic unfold. The previous owner had to pay staff for the front desk, cleaning, laundry, all of it. Papa Patel fires everyone. He and his wife run the front desk. The kids pitch in cleaning rooms after school and on weekends. Operating costs drop to almost nothing. Because he's the lowest cost operator in town, he can offer the lowest room rates. This drives occupancy through the roof, and suddenly he's making more profit per room than competitors who would go broke trying to match his prices. The family lives simply. Home-cooked meals, no vacations, every dollar funneled into paying down the mortgage at lightning speed. Within just a few years, they own the property outright. The return on that initial $5,000 investment? Absolutely astronomical. But what about risk? What if it all fell apart? This is where Dhandho really shines. Papa Patel looked hard at the downside, and it was tiny. If the motel failed and the bank foreclosed, what would he actually lose? His $5,000. He had virtually nothing else for the bank to take. His personal guarantee was meaningless, and in that worst-case scenario, he and his wife could get minimum-wage jobs, save for a couple of years, and try again. The odds of failing twice in a row? Incredibly small. But the upside? Life-changing. A perfect coin toss where the odds were completely stacked in his favor. Heads, I win big. Tails, I don't lose much. This simple formula, repeated by thousands of Patel families, is what led to their complete domination of the motel industry. They weren't innovators. They were brilliant copycats. The first few Patels figured out the model, and everyone who followed just lifted that proven blueprint and scaled it nationwide. Pabrai shows us this wasn't just a one-time historical accident. He tells us about Manilal Chaudhary, another Gujarati immigrant who arrived in 1991 with nothing. Manilal worked 16-hour days at a gas station, 7 days a week, saving every single penny. He and his siblings pooled resources, lived together, and waited patiently for the right moment. That moment came after September 11, 2001. The travel industry was in chaos again. Fear everywhere. Motels on their knees. Just like Papa Patel decades earlier, Manilal saw a distressed business in a distressed industry. He found a beautiful Best Western motel on sale at a deeply discounted $4.5 million. His family had saved $225,000. They cobbled together another $125,000 through home equity loans and partnerships to make the down payment. He took over, applied the same low-cost Dhandho principles, and just 4 years later, that property was worth over $9 million. His family's initial investment had nearly quintupled, not even counting the substantial annual cash flow. One big bet made it maximum pessimism, with odds overwhelmingly in his favor. Heads, I win. Tails, I don't lose much. Now you might be thinking this only works for hard-working immigrants from India. But Pabrai brilliantly shows us it's universal by introducing someone completely different. The flamboyant, life-loving British billionaire Sir Richard Branson. Branson seems like the ultimate risk-taker, right? But Pabrai reveals he's actually a master of Dhandho. Take Virgin Atlantic Airlines. In 1984, Branson knew absolutely nothing about airlines. He was running a successful record company when someone pitched him a plan to start an airline between London and New York. His partners thought he'd lost his mind. "You'll need a 747 jumbo jet," they said. "Do you have any idea what that costs?" Branson didn't write some massive business plan or chase venture capital. He picked up the phone, called Boeing, and asked if they had an old 747 lying around they'd be willing to lease for just 1 year. Incredibly, Boeing said yes. Then Branson realized something beautiful about airline economics. Passengers pay for tickets about 20 days before the flight, but he wouldn't have to pay for fuel until 30 days after landing. His working capital needs were virtually zero. With Boeing's favorable lease, his total downside risk, the absolute maximum he could lose if everything crashed and burned, was just $2 million. Meanwhile, his record company was on track to make $12 million that year. He bet a small fraction of his company's earnings on an idea with massive upside potential. He saw terrible service from existing airlines and went for the gap. Heads, I win. Tails, I don't lose much. This became the blueprint for the entire Virgin Empire. Virgin Mobile doesn't own cell towers. It piggybacks on Sprint's network. Virgin Pulse Electronics at Target didn't require building factories. They found a Chinese manufacturer. Across over 200 businesses, the pattern repeats. Enter markets with minimal capital and minimal risk. From the Patels to Branson, we're seeing a clear pattern. But Pabrai takes it even further with Lakshmi Mittal, one of the world's richest men. While Bill Gates built his fortune in high-margin software, Mittal chose one of the worst industries imaginable: steel. Steel mills are capital-intensive nightmares with unionized workforces and zero control over raw material costs or product pricing. It's brutal. Most companies go bankrupt. So how did Mittal become the king of steel? Dhandho, of course. He didn't build expensive new mills. He waited for existing ones to fail. He'd find state-owned, inefficient, cash-bleeding steel plants in places like Kazakhstan or Romania on the verge of collapse. Governments were so desperate, they'd practically give him the keys for free just to save jobs. Mittal would take over these massive assets, which cost billions to build, for pennies on the dollar. Then he'd apply his operational genius, streamline everything, and turn them into cash machines. His entire strategy was built on a core Dhandho principle: buy distressed businesses in distressed industries. He was buying dollar bills for 10 cents. So how do we actually apply this? Pabrai distills these stories into the Dhandho framework, 9 simple but powerful principles. First, focus on buying existing businesses. Startups are insanely risky. Papa Patel didn't build a new motel. He bought one with analyzable history. In stocks, this means buying established companies, not speculative ventures. Second, buy simple businesses: motels, steel mills, record companies, businesses you can actually understand. Pabrai, like his hero Warren Buffett, believes change is the enemy of investors. If you can't explain what a business does in a few simple sentences, walk away. Third, as we saw with Mittal and the Patels, buy distressed businesses in distressed industries. The best buying happens when there's blood in the streets, when fear is high, and the future looks bleak. As Buffett says, be fearful when others are greedy, and greedy when others are fearful. Fourth, buy businesses with durable competitive advantages, what Buffett calls a moat. For Papa Patel, his moat was being the absolute lowest cost operator. Nobody could touch his prices. For Geico, it's their direct-to-consumer model, giving them a permanent 15% cost advantage. A moat protects profits from invaders. Fifth, bet heavily when odds are overwhelmingly in your favor. Pabrai calls this few bets, big bets, infrequent bets. Most of the time, you do nothing, you wait. But when that rare, no-brainer opportunity appears, you don't just dip your toe in. You go big. He introduces the Kelly formula, which mathematically determines optimal bet sizing. Papa Patel and Buffett may never have used the actual formula, but they intuitively understood it. When you find a mispriced gamble, you load up. Sixth, fixate on arbitrage. Arbitrage is essentially risk-free profit. Pabrai uses a great analogy of a barber in a growing town. If he's the only barber for 17 miles, that distance is his arbitrage. He can charge more and deliver slightly worse service, and people will still come because it's convenient. Eventually, competition arrives, and that spread disappears. but for a few years he rakes in abnormal profits with minimal risk. Dhandho is about finding these temporary market gaps. Seventh, and perhaps most important, demand a margin of safety, always. This is value investing's cornerstone, championed by Benjamin Graham. Simply put, buy things for significantly less than they're worth. If you calculate a business is worth $1 per share, you don't buy it 90 cents. You wait until Mr. Market, in one of his mood swings, offers it for 50 cents. That 50-cent gap is your margin of safety. It protects you when you're wrong and gives spectacular returns when you're right. The bigger the discount, the lower the risk and higher the potential return. Eighth, invest in low-risk, high-uncertainty businesses. This is subtle but crucial. Wall Street hates uncertainty. It confuses uncertainty with risk and punishes stocks accordingly. High risk means many possible outcomes, with many being negative. High uncertainty means many possible outcomes, but none resulting in permanent capital loss. Pabrai gives the example of Stewart Enterprises, a funeral home company he invested in. It was drowning in debt, and Wall Street priced the stock like bankruptcy was certain. Huge uncertainty about how they'd solve their debt problem. But Pabrai realized the underlying funeral home business is incredibly stable and predictable. The company owned hundreds of profitable locations. He calculated that even in worst-case bankruptcy, the hard assets were worth more than the stock price. The risk of losing money was tiny. He made the bet, the company sold assets to pay down debt, uncertainty lifted, and the stock soared. Heads, I win. Tails, I don't lose much. The ninth and final principle is liberating. Invest in copycats rather than innovators. Innovation, Pabrai argues, is a crapshoot. Real money often comes from taking proven concepts and executing better. McDonald's didn't invent fast food hamburgers. Ray Kroc copied the model from the McDonald brothers and scaled brilliantly. Microsoft didn't invent graphical interfaces or spreadsheets. They copied and bundled them into a dominant operating system. Pabrai even applied this to his own investment fund, shamelessly cloning Buffett's fee structure and principles. Cloning is certain. Innovation is gambling. Now, buying is only half the battle. Knowing when to sell is often harder. For this, Pabrai introduces a tragic hero from the ancient Indian epic Mahabharata, the young warrior Abhimanyu. Abhimanyu knew how to enter the enemy's deadly spiral battle formation, the Chakravyuh. He'd learned the secret while in his mother's womb, but as he learned the entry, his mother fell asleep, so he never learned the exit. He entered the battle, fought bravely, but was trapped and ultimately killed. His dilemma mirrors ours as investors. We get excited about buying stocks, about entering the Chakravyuh, but rarely have clear exit plans. Pabrai offers a simple, powerful rule to protect us from our emotional brains. Any stock you buy cannot be sold at a loss within 2 to 3 years of purchase. Why? Because businesses have ups and downs. If you buy a great business at a great price, and the stock drops 50% on bad news, our fearful brains scream, "Sell, run!" This rule forces you to give the business time for uncertainty clouds to clear. Real business change takes time. More often than not, if your initial analysis was sound, the market eventually recognizes true value. Pabrai shows how this rule saved him from huge losses and turned a failing steel company investment, Universal Stainless, into a big winner. After 2 to 3 years, though, the shackles come off. If the investment is still underwater, you likely made a mistake in your initial judgment. At that point, sell, take the loss, and learn from it. So how do you actually practice this without spending your entire life analyzing stocks? Pabrai acknowledges that for most people, a low-cost index fund is perfectly fine. But for those willing to do a bit more work, there's a better way. He points to Joel Greenblatt's magic formula, a simple algorithm finding good businesses at cheap prices. Pabrai calls this the Dhandho Index. It's an automatic way to fish in a pond full of undervalued companies. You can simply buy a portfolio of 25 to 30 of these stocks and hold for a year, likely beating broad market indexes. Or use that list as your hunting ground. Instead of searching through thousands of companies, start with a pre-screened list of a few hundred promising candidates. This brings us to the final lesson from the Mahabharata, the story of Arjuna, Abhimanyu's father and the world's greatest archer. His teacher, Dronacharya, sets up a test. He places a wooden fish on a pole and asks students to shoot its eye by looking at its reflection in a pool below. He calls the first student forward and asks, "What do you see?" The student replies, "I see the ground, the water, the pole, and the fish." Dronacharya tells him to sit down. Another student says, "I see the water, the pole, and the fish's reflection." He too sits down. Finally, Arjuna steps forward. Dronacharya asks, "What do you see?" Arjuna replies, "I see only the center of the fish's eye." "Fire," says Dronacharya, "the arrow hits perfectly." This is the final Dhandho puzzle piece. In a world with thousands of investment options and endless noise, the Dhandho investor defines their narrow circle of competence, the simple businesses they truly understand. They ignore everything else. They watch and wait patiently, scanning the radar. And when that one perfect opportunity appears, that deeply undervalued, simple, distressed business with a durable moat, they shut everything else out. They focus with Arjuna's single-minded intensity. All they see is the eye of the fish. What I find so profoundly beautiful about the Dhandho investor is its simplicity. In a world constantly telling us that making money is complex, requiring fancy algorithms, finance PhDs, and huge risks, Mohnish Pabrai brings us back to a timeless fundamental truth. Wealth creation is often about doing simple things patiently, with relentless focus on not losing money. The book's core mantra, "Heads, I win, tails, I don't lose much," is more than investment strategy. It's a way of thinking applicable to almost any major life decision. Before starting a new project, taking a new job, or making a significant commitment, ask yourself, what's the absolute worst-case scenario? Can I live with it? Is it survivable? And what's the potential upside? If the downside is limited and the upside significant, you've found a Dhandho opportunity. This mindset is incredibly liberating because it removes the terror of catastrophic failure. It encourages making bets, but smart bets. It reframes risk, not as something to embrace for its own sake, but something to intelligently and ruthlessly minimize. The most actionable takeaway for anyone right now is to start building your own Dhandho Index watch list. You don't have to invest a single dollar yet. Just visit a free online stock screener. Pabrai mentions Joel Greenblatt's Magic Formula website as a great starting point, and pull up a list of companies that are both good, meaning high return on capital, and cheap, meaning low price to earnings ratio. Pick one or two from industries you find simple and understandable. Maybe a restaurant chain, clothing brand, or furniture store. Then just start reading. Read their annual report. See what the CEO is saying. You're not trying to become a Wall Street guru overnight. You're practicing the art of Arjuna, learning to focus on one target at a time. You're building your circle of competence, one simple business at a time. Pabrai ends his book with a powerful reflection that's essential to mention. He reminds us the Dhandho framework is a tool to build wealth, But wealth itself isn't the ultimate goal. He shares a story about his friend who, after becoming a successful entrepreneur, dedicated his fortune to helping the poorest of the poor in India. When asked why, his friend simply replied, "Helping you makes me happy." Pabrai urges us to use whatever wealth we create not just for ourselves, but to leave the world a little better than we found it. And that, perhaps, is the wisest investment of all. That was a summary of the Dhandho Investor by Mohnish Pabrai. We've touched on the core principles today, but I have to be honest. A summary is like looking at a photograph of a grand feast. You can see what's on the table, but you can't taste the food. The real magic of this book is in the stories, the details, and the way Pabrai's thinking slowly seeps into your own. This summary is designed to help you decide if this book is worth your time. If the idea of low-risk, high-return investing has sparked your curiosity, if the mantra, heads, I win, tails, I don't lose much, resonates with you, then I encourage you to grab a copy. Reading it is an experience that could fundamentally change how you think about building wealth. Also, if you found this journey valuable, please take a moment to click that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.